Hey folks, this is your weekly, most comprehensive look at the world of business, finance and economics. Welcome to another episode of Business Redefined. We are getting neck deep into the budget season. Budget for FY 2024-25 that is running between the period July 2024 to June 2025. But before that, we have seen the Supplementary Budget Ii for FY 2023-24, which was made public late last week, and we are delighted to have on set Churchill Ogutu, economist at IC Group. Churchill, always a pleasure.
Thanks, Julian, for having me.
Karibu sana, Churchill.
Shukran.
Looking at the supplementary budget headline figures, it looks to me like Treasury was on a mission to correct the expansion we saw via Supplementary Budget I, because if you look at it, there's a bit of reduction in the budget for the financial year currently. I don't know what you make of the headline figures from the supplementary budget.
If you look at the Supplementary Budget II, there's a net reduction of 46 billion. But how to look at it is quite interesting because there's some reduction on the recurrent spending, and also there's been an increase in recurrent spending, and there's been a reduction, a significant reduction in development spending. So, and if you look at even Supplementary I, that was pretty much what played out. That recurrent goes higher. Development, there's been a bit some significant reduction in that in the development spending. But if you look at the genesis around Supplementary Budget II, this was part of the IMF program conditions, structural benchmark, that by March of this year, we should have received Supplementary II. But by then, it was hinged on lower revenue outturn by that point, by December last year. And there was a need of now having some corrective measures on the revenue side and also reducing the expenditure. So I think if you look at the Supplementary Budget II, it has sort of penciled in that. But over and above that, I don't think that there's some urgency within the context of the IMF program, because we're seeing some newer emerging issues being baked into the Supplementary II. We're seeing things like El Nino, we are seeing things like floods and emergency spending. This had not been envisaged by the time the IMF program or by the time the IMF report came out in January. So I think that it was a way of just taking advantage of what has happened right now and now bringing Supplementary II. In the whole balance of things, if you look at the spending reduction to the national government, that is to the executive, judiciary, and legislative, negative 46 billion reduction vis-a-vis the revenue outturn for the first 9 months. I expected some bigger reduction in spending, so negative 46 billion is quite low. Obviously, when you look at the Consolidated Fund Services, that is now the interest payments and the other salaries, pensions and all that. There's also some significant reductions, I think to the order of 21 billion in terms of the the interest payments. There's been reduced by around 46 billion. And then the other Consolidated Fund Services by another 21 billion. So I think that is where you can say that that's where the significant cuts came about. Okay. Within the Supplementary Budget II context.
Let's speak about the revenue, Churchill. Massive downgrades on that side. If I could just run through them. Target for revenue, total revenue has been slashed by 5.3% to 2.89 trillion shillings. Ordinary revenue slashed by 4.84% to 2.45 trillion. If you look at the various tax heads, the largest slash I was seeing was coming from import duty and excise, slashed by 17.8 and 17.6% respectively. It looks like we're having a very tough financial year from a revenue outturn perspective.
Look at the outturn between July to March of this year. The actual collection vis-a-vis the target is around 270 billion. That is that is within the total revenue. Yep. Ordinary revenue 255 billion, shy of the targets. At least appropriation in aid was just shy of 15 billion thereabout. So that now speaks to your numbers that you're talking about, that because of the outturn that we've seen, and just remaining with 3 months, obviously there's a need of scaling down the revenues, at least on the ordinary revenue side. So I looked something like a reduction of 100 billion. So if you look at the target, revised target in terms of the ordinary revenue for the current financial year, 2.43 trillion, that is within the quantitative performance criteria within the IMF program, which is around 2.42 trillion, 2.42. Revised target is 2.43 trillion. So that's, I'm still doubtful they'll be able to get it. And we all know that the seventh reviews is still ongoing.
Yes.
So we might see some refacing or some revision on the quantitative targets in terms of the tax revenue to be collected in this
under the IMF program for that
within
one.
the IMF program, yeah, because the targets for end of June, the tax revenue within the quantitative performance criteria will be the basis of the next review. So obviously it will be within the Kenyan authorities to at least revise it at least to more meaningful level, so that once the next review comes in from around November thereabout, at least it may give them some much more, the review will give it some much better shape in my view, yeah.
But Churchill, here's where you and I tend to differ in every budget cycle. One is that I still think, the challenges we're seeing notwithstanding, 9 months in the current financial year off target by about 270 billion. I still think the revenue outturn will be in the 95% horizon. Reason being, two things we have this time in this financial year. We have the voluntary tax disclosure program coming to an end, but more importantly, we have the tax amnesty program, which is also running. So don't you think those ones still could give us a bumper collection in the last quarter?
Obviously, and we are getting into the final quarter of this current financial year, whereby we normally have some two outlier months, that's April and June. So there's some scope that we can now be able to, reduce that eventual deficit that is being envisaged. But then again, if you look at it as at March, the deficit was 1.5 trillion. Right now, in the context of Supplementary 2, it's around 1.4 trillion shillings that needs to be met. Yeah. I don't think that even in the most bullish scenario, we may now be able to realize 1.4 trillion in 3 months. I highly doubt that will be the case. So based on that, obviously 95% is normally an A for you. I look at my threshold is 90%, so that's normally where our divergence is. But I'm still skeptical that the overall revenue target in the current financial year will be met. It
will not be met, certainly. But the elephant in the room in the numbers we've now seen from the National Treasury, Churchill, is the fiscal deficit. You remember when we started FY 2023-24, the target was 4.7% of GDP. Supplementary Budget Ii just took it to 5.7. From the latest numbers, we're now seeing 5.6% of GDP. Yeah. The aggregate fiscal deficit is 908 billion shillings. When I interviewed the CBK governor in December last year, he told me Supplementary 2 will bring it back to sub 5%. We clearly have a problem here.
Obviously, that's a concern. And actually, the numbers within the original budget was 4.4%. A supplementary budget took it to 5.5%. So in terms of the targets was 5.5%. But then again, an interesting thing came, if you noticed within the context that in as much as they had penciled in 5.5%, they are hopeful that will even come below 5%. They had penciled in 4.9% as the actual outturn for Supplementary 1. So that also implied some increase in revenue by around 0.1% and some reduction in expenditure by 0.5%. So the 5.5% that has been penciled in vis-a-vis what they anticipated eventually will be the final outcome. So that means that for them to meet a more realistic target, remember that even investors are keeping an eye that we need to see that fiscal consolidation coming into play. Yeah. So if we came from 4.4% in the original target, obviously 5% is the next threshold. Anything above 5% will just send some warning signal to investors. So probably that might imply that spending may not even meet it 100%, because obviously from the look of things, revenue might be quite ambitious to be able to meet. So what we saw playing out in Supplementary 1, that 5.5 was 5.5%, but now they were looking at 4.9%, might also play out right now that you're seeing 5.6% of the GDP, but it could even be lower with lower spending within the current fiscal year.
On that point of fiscal deficit, Churchill, is it just me or the 7th review of the IMF program looks unusually prolonged? And could this be the sticky issue between the government and the fund. They began meeting, 3 weeks ago, before the World Bank IMF spring meetings. To the best of my knowledge, I'm still told that they are meeting now virtually. We haven't seen a staff level agreement. Is this unusual? Is this usual? What's playing out here?
I think it's unusual. Even in my expectations was that before the spring meetings, at least a staff level agreement will have been reached. And this was coming at a point where both Kenya and Ghana were having IMF missions. Yeah. Before the spring meetings,
we saw
Ghana's staff level agreement came about. But if you look at even the outturn for Ghana has been quite more positive. So that also implied that a staff level agreement was reached faster than Kenya's. So I believe that the elephant in the room is now on the revenue outturn. So that is obviously bringing up some issues with the IMF and also some of the structural benchmarks. Remember that even this supplementary budget II was supposed to have been tabled in March.
Yes.
There's also issues around Petroleum Development Fund, how to bring about some legal frameworks to ring fence revenues around that. Was supposed to have been done by March. We haven't seen that. So I think even over and above the quantitative performance criteria, that's where the revenue comes in, but also the structural benchmarks. There have been some delays in implementation. Yeah. So I think those are some of the issues that have now prolonged this program. But from the news flow we've had, we could see something sometime later this week.
Okay. Looking at the borrowing side, domestic target slashed to 407 billion shillings, external financing upgraded. And if you look at the upgrade, it basically, in my assessment, just factors in the Eurobond floated earlier this year. What did you make of that adjustment?
Similarly, the Eurobond, the buyback that happened in February hadn't been penciled in even by the time Supplementary Budget I but Supplementary Budget I was actually enacted into law. We hadn't thought about buyback, but right now we are looking primarily multilateral financing, the World Bank, the IMF. Those were all on course. Yeah. So I think on the external side, that speaks to the buyback that came in. I'm actually impressed in terms of the domestic financing. As at end of March, the authorities tell us that it was 387 billion. So that implies that for the last quarter, basically from April to June, they just have to raise 20 billion at least to be able to meet this revised 407 billion domestic financing. So that's quite interesting. And I think just looking at it in isolation, that lends to the view that rates should go lower. But obviously, if you now contextualize it, domestic rates, now the yields in the domestic markets have been quite elevated as it is, just looking at everything on balance, not just domestic financing coming from 474 as at 474 billion after supplementary one to 407 billion. But obviously, just to contextualize it, that speaks to how the rates have been quite elevated.
Sachel, do you really expect, because I don't, that yields will come down in this market? And why I say that is because I remember about a month ago, on the back of the Eurobond, there was so much hype that we have seen the end of the 18s. I said the yields would still be sticky. If you look at the latest auction in the T-bill market, all went up across all tenors, 91-day, 182, 364. And if you look at the 10-year that was reopened, the subscription was really pitiable. 16% was the coupon. Of course, guys would argue, if you look at the T-bill market, there wasn't much difference. But if you look at the maturities that were coming to market, it would have made sense. I still believe that yields will remain high.
By all indications, we are seeing yields remaining sticky as compared to the expectations after the buyback that happened in February and also the infrastructure bond that was issued in February. So right now the focus is over and above the fact that domestic borrowing, in as much as that infrastructure bond that was issued in February sort of now brought the borrowing target closer to ahead of schedule. There's still some concerns if you look at it, balance of things. Remember that revenue outturn has been quite dismal, and external financing, we are supposed to get some $1.5 billion, scaled down to $1.2 billion from the World Bank. IMF, who knows whether it will spill over to the next financial year. I mean, this is the trend we've seen, that as review is finalized in May, disbursement is usually in July. So I think those are the concerns. So I find that the heavy lifting still will be done from domestic side. But speaking onto the issuance, obviously, it's quite, those are the things that even the market look at. And in as much as the government at some point tried to signal that lower rates will be on the horizon, remember that this 10-year that was reopened last week, it was preset at 16%, the coupon rate. Had it gone to the market, it could have been there about 18%, thereabout. So right now the market, there's like a tug of war between the authorities on one side. They might want to nudge the yields lower, but the market, just looking at everything else, they might want it at higher levels. So within that tug of war, that now led to the lower subscription rate that you saw in the last auction.
Treasury, if you look at the budget estimates for 24-25, has hinted that they want to lock infrastructure bonds to retail investors. And their argument is that we need to address the pricing and address the challenge of competition between the infrastructure bonds, which are tax-free, and the standard bonds, which are not tax-free. I see challenges with it, but I'm very curious as to what you would think about that.
First, it doesn't make sense in the sense that that once an infrastructure bond is issued, either the government is distressed, so it wants to meet its borrowing target, or they just want to, or there's a low subscription rate in the non-infrastructure bonds, so they just want now to bring something at least to entice to the market. And also, foreign investors, they also prefer infrastructure bonds vis-a-vis the non-infrastructure bond issues. Having said that, not to segregate and just leave it entirely to retail investors. Remember that retail investors are quite, their muscle is quite low. So what does that speak? That for us, up until this point, whereby we know that infrastructure bonds have had an outsized subscription, is it that now going forward, it will be low subscription? The other thing, obviously, is if you look at the retail investors, them, they are pretty much in terms of total return. I'm getting in here, I just want to make gains, be it the coupons or majorly on the coupons, because these retail investors, they may not be buy and sell like institutional investors do. For institutional investors, some of them, if you sort of demarcate it, you find that a number of them are liability-oriented investors, be it banks, asset liability matching, mandates,
pension funds as well.
Pension funds because of the liabilities that come due. So you find that this proposal that infrastructure bond is now targeted towards retail investors, does it also bring on board the liability investing mandates by institutional investors? So I don't think that had been factored in. I think they were looking at it from the perspective that because domestic borrowing rates have been quite elevated, so as a way of nudging the rates much lower, they would rather exclude the institutional investors who, for some reason, they think have nudged the rates higher. But you see, institutional investors, they see things as they are. They look at the demand-supply dynamics, and then they price as per what they view the pricing should be, ideally. So I think the best way is now to sort of, Emakiba bond will have worked well. If they want to find a product that is specifically for retail investors, Emakiba bond ticks the boxes because fixed coupon rate, it's like a savings rather than an investment product. So that is the best route to go, rather than now bringing chaos with this demarcation of the market.
Chacha, let's talk about the consolidated fund services. I noticed guaranteed debt is off. Of course, you can see the slashes in external interest. I think that's an FX impact. But domestic is quite heavy, looking especially into this financial year and the next one.
I think also they have penciled in the infrastructure bond for domestic interest, the 240 billion that was picked up and at 18%. So that also speaks to the increase in domestic interest into the next financial year primarily. On guaranteed debt, there was that reduction of the guaranteed debt. It was around 18 billion in the last financial year and also into the current financial year. That one was slashed off. But remember, that has been always below 2 billion.
Yeah.
The increase in the last financial year was obviously just to the government support of supporting the payment of the interest by Kenya Airways. But if I may, we take a step back to the IMF report in January, talking about the state-owned entities. One of the things that was supposed to have been tabled by right now was a restructuring, some options of restructuring Kenya Airways. That one was supposed to have been done by end of last month. So is it that Treasury, within the context of Supplementary Ii, and also into the next financial year, sort of signaling that Kenya Airways will be restructured and hence no need of meeting the interest payment by the government? So that is what was my reading by the reduction in the guaranteed debt.
Budget estimates for FY 24-25, we have seen them. I don't know what you take from there. I have seen a number of slashes based on the numbers we're seeing for Supplementary Budget 1. Of course, now we've seen Supplementary Budget 2, but it looks like we are really putting out a signal as a country that as far as fiscal consolidation is concerned, we are really trying to pursue that route, the constraints notwithstanding.
Yeah, a number of things to take from FY 2024-2025 budget in terms of the slashing. Majorly was on development, affecting infrastructure, medical services, and also defense and energy. On recurrent, significant slashes were on education.
Correct.
Comparing the table estimates vis-a-vis the budget policy statement, the approved numbers by Parliament a couple of months ago. And that obviously speaks to the consolidation. I think last month, President Ruto in Accra preempted that there could be some slashes on the budget. We've seen it in supplementary and also right now the FY 2024-2025 budget coming in. So that's pretty much in. The other issue that we are seeing, I think it's all playing to the fact that the IMF program is coming to an end.
Yeah.
Fiscal deficit is at 2.9%. I mean, this is even lower than 3%. This is the target over the years that we need to reach 3.3%.
Yeah.
It's like we are meeting it in the next financial year, but then if you look at the other financial years, there's some increase, 3.3% for the next 3 financial years. So my reading of that, and also looking at it in terms of the revenue, we are coming from a point that this current financial year, the revenue is around 2.4 trillion ordinary revenue. Next year is at 2.9 trillion. So there's something for 460 to 500 billion increase in the revenue. Obviously speaks to fiscal consolidation that is geared towards revenue mobilization. And I'm still having my doubts. We still haven't seen the finance bill, so we may give it some benefit of doubt. The other thing that I was quite impressed by this budget was now incorporating bottom-up economic transformation agenda, and then they sort of clustered those themes and also sort of put a figure to it, 257 billion. But the other thing is that if you compare with medium-term plan 4, the expenditure, this budget allocation is quite high, 3.6 trillion vis-a-vis what has been allocated, 257 billion. And what does that mean, Julians, is that remember that this budget is a cycle. We started all the way from budget review outlook paper around August, September last year. And one of the things that caught my eye within the sector, macro sector working group was that the budget requirement was at 4.1 trillion. What has been allocated to the national government is 2.3 trillion. Yeah. That now speaks that there could be a window that on the spending side, things might increase. We've seen that, yes, the budget estimates have been tabled. It's now under the Budget Appropriation Committee. But the Budget Appropriation Committee will now engage with the different committees of the House, and that's where you can find that there's some fiscal slippages, some expenditure that a committee might want to be incorporated in the budget may now be incorporated. So all this fiscal consolidation as it is right now, it's well good. There's some good intent to that. But I think if you start looking at the practicability around it, I find that there could be some slippages, and more so towards the tail end of the next fiscal year on the back of the ending of the IMF program.
All right. And that point by Churchill Ogutu takes us to the close of our conversation, where we have been focusing on matters regarding Supplementary Budget II for 23-24, as well as the budget estimates for 24-25, which we have now seen. We remain in wait for the finance bill to give you the breakdown as and when it drops. Stay tuned.